Hello, this is Bill Moreland with Bank Reg Data. Today we're going to take a look at the construction other land portfolio. These are going to be primarily all construction loans and lot improvement loans that are non 1 to 4 residential building related. So 1 to 4 is a whole different animal. It's got its own portfolio. This is going to be all construction loans, non 1 to 4. And essentially what we see is some pretty crazy growth, right? So construction other land growth is basically skyrocketed up to that 403, 403, 404 range, kind of peaking out right there at 404, 192. And we're seeing it's kind of peeling back a little bit. We're going to take a look at the entire industry because a lot of charts in the data and a lot of individual banks will look this way as well. Massive growth in something. And really what it comes back down to is the $5 trillion of new money that was pushed into the system, and it all flowed into banks in 2020, 21, and 22. We had a $14.6 trillion base in banks deposits primarily. And within 2.5, 3 years, the number climbed to almost $20 trillion. And so banks had to do something with this. And a lot of banks bought securities and they got in trouble. A lot of banks have been doing lending and now we're getting into trouble. And this will highlight this. This is crazy growth. I'm a credit collections guy by nature, first 13 years of my career, and I'm very skeptical of fast loan growth. So if we come over here on the left-hand side in Excel, we will see what the loan portfolio was at 2019 Q4, which was $282 billion. At that time, delinquencies were 77 basis points. Within how many quarters of this? 18, 19 quarters. We basically grew $122 billion or 43%. That is a lot of loan growth. And so the reason banks have stopped lending recently is because of that. Delinquencies are starting to climb quite aggressively. Coincidentally, so is loan modifications, right? And that's kind of what we see a lot right now. This time around, banks are much, much, much more aggressive in loan modifications. And so we'll look at this. Let's pop into early stage delinquencies. We see a periodic spikes, 1.6 down to 1, 1.6 down to 1.3. But the general trend of early stage delinquencies, accruing fee and interest income in the construction portfolio is up. I mean, it's basically up. Non-performing loans clearly are way up. And total delinquencies will be the two of those combined. So it'll be early stage accruing interest, late stage accruing interest. Anything on non-accrual is what total delinquencies are. So if we scroll down here, we're going to see a couple of different things. We see the total delinquencies just keep climbing and climbing and climbing. And we see that 9 basis points this quarter is bigger than the 3 basis points prior quarter. So you do see some jumps, some stable, some jumps. Scrolling down here, the 127 is his highest delinquency rate we have had since going back to 2016 Q1. So we're nowhere near where we were in 2012, 13, 14, where the construction delinquency rates were 6, 7, 8, 10%. But we've clearly inverted, and the portfolio is deteriorating, and in some ways is deteriorating quicker quarter on quarter. Coming down, we can see what it is by asset size. So this is going to be total delinquencies to total delinquencies to total construction portfolio outstanding. And the largest banks have some delinquencies. The smaller you get, sub $5 billion has quite a few delinquencies. But those regional banks, those $5 to $1 trillion banks, are sitting at 181, 102 basis points, right? Not a lot. Individually, there'll be some banks in there that look like they have. So really, the thing to look at is modifications. Every time you look at delinquencies, go look at modifications. So on the left-hand side, we'll cycle over here and we'll look at the total loan book that is delinquent. And we can see 4.94 billion, 127 basis points of delinquency. We come over here and we see essentially same portfolio, all U.S. banks, what is being modified. So there's your 4.94 billion, 127 basis points, ties the 4.94, 127 there. But we see they restructured another almost $4 billion. Of that $3.95 billion of loan mods, 21% is delinquent. So it will show up there. Or non-accrual. Non-accrual could be delinquent, or it could just be on non-accrual accounting purposes. But that 3.1 billion number is additive. So when you look at portfolio stress, really what you have to look at is that number plus that number. But you can see over here, I mean, 120, 196, 97 basis points, 115, 118, 127. But during this time, we've gone from 47 basis points of extend and pretend to 55 to 70 to 80. So clearly, some banks are getting very, very aggressive in loan modifications. These are lowering payments so that the borrower stays out of delinquency. If we look at total portfolio stress, which is delinquencies plus performing mods, it's 2.08% of the industry's book. So this is a portfolio that is getting, once again, we're having to go back to 2016 timeframes since the last time we saw delinquencies these high. And what I often hear is, well, Bill, it's 2.08 versus 186. It's worse, but it's not horrible. Well, yeah, but why is it going to stop at 2.08, right? I mean, trends usually get better across time, and then they tend to get worse across time. And what you never really know is, where's the peak? Are we along the peak? Or is the peak going to be 3 or 4 or 5%? And I don't know. But what I do know is it is getting worse. And it's been getting worse 1, 2, 3, 4, 5, 6, 7, 8, 2 years. For 8 straight quarters, with the exception of one little dip right there, it's gotten worse every single quarter. So what we're going to do is we're going to pop back down to the delinquencies. This is the all U.S. banks. We're going to cycle down. We already looked at the time frame. We already looked at the asset size. Now what we're going to do is look at the individual banks in here. So this is the top 100 lenders in the space. And so we can see Wells Fargo has $17.8 billion, $220 million of delinquencies for 1.23%. So we're just going to look at 4 or 5 of these guys. There's Wells Fargo. There's total delinquencies. So I'm going to go ahead and, as always, put it over here on the left-hand side. And we see that their early stage delinquencies are elevated consistently, but they fluctuate, but they're consistently red. Their late stage delinquencies had been going up, but not atrociously bad, 48 basis points versus 20 versus 2. So their total delinquencies look like they're not horrible relative to what they've been across time. But the reason is it's being manipulated, as always. So when you read the 10Ks, 10Qs, and you hear about their delinquencies don't look so bad, what you have to understand is you have to ask more questions. If the number is legitimate, we're all happy. But if you start to see a lot of extend and pretend, so they report 220 and 123, 220, 123. So 220 million are delinquent, but they've modified another $226 million, and it's all extend and pretend. None of it was put on non-accrual. So this number looks the way it looks because they're managing the delinquencies. And every quarter, they're doing more and more and more of loan modifications. When we look at total delinquencies plus the extend and pretend, which is additive, so that number and that row number is additive, we see that they're higher than they have been in a long, long time. So while the industry is not quite higher, they are. All right, so we'll close this one down. That's the largest lender. Let's take a look at JP Morgan Chase. 13.9 billion, 497 million, 3.56%. We see delinquencies climb, but they've always been really high, haven't they? They've always had a high delinquency portfolio. Are they charging them off? That always is the question. Doesn't look like it. So there is an REO component, but it doesn't look like they're charging off anything. If I come over to assets, I go to REO, I come down to construction, nothing. Now, it doesn't mean they're not selling them, but my gut on this is they're just never taking charge-offs in that portfolio. For whatever reason, they are basically, and look at them, they're lending like crazy. One thing I didn't show with Wells is, if I remember correctly, Wells is getting out of the book, right? And they're quickly not going to be the number one largest guy anymore. It's probably going to be JP Morgan, but Wells is getting out. They are well below where they were even going back to 2022. They've got to be selling these loans. They've got to be. JP Morgan is climbing like crazy. Their delinquencies over here are very, very elevated. I don't think they ever charge anything off. Are they doing a lot of extend and pretend? A little, but not much. So JP Morgan's delinquencies are probably more reflective of what's going on in a clean book, but they're very elevated. What surprises me is that's $5 billion of new growth. Part of that would be an acquisition, I suspect, right there. But the other, that's a lot of loan growth. So JP Morgan, elevated delinquencies, not really an extend and pretend. It's coming to Bank of America. Their delinquencies look fantastic. Now, granted, they're about what peers are doing, but notice they've doubled for them, right? They were 40, 50, 60 basis points. Now they're 120, 100, and 115 basis points. So once again, is this a Wells Fargo scenario where they're just playing with numbers and loan mods? Or is this a JP Morgan scenario where they're basically doing more extend and pretend? We go to mods, and it's clear as day. The reason the delinquencies have moderated to only 115, 117 basis points is extend and pretend. 126 million of total delinquencies, 115 basis points. They've modified 397. It's 386 is extend and pretend. Their total portfolio stress is horrendous. 467 basis points. What are their reserves on this portfolio? 2%? 3%? 4%? There's a good chance that they're very under-reserved on that portfolio. So we see Wells Fargo and Bank of America doing the same thing. Let's pop down here and look at this next batch. Truist, US Bank, and OZK. I'll stay away from OZK for now. They're a whole other discussion. I could spend 20 minutes on talking about them. But let's take a look at how do you have 5 basis points? How do you have 5 basis points? So let's go to US Bank. And what do we see? All right. Come over here. Construction, other land, total delinquencies were getting worse. And they were getting worse very quickly. And then they magically get better. And then they magically drop to nothing. Were they, yeah, maybe they're selling some of those guys off, but it's only about 600. It's only about 8-9% drop. But their delinquencies they look ridiculous. I mean, what's 5 basis points of delinquencies on this portfolio? You're in the 19th percentile, right? I mean, you are 80%, 81% of the banks have worse delinquencies. Well, how? So that's always the question. How? Is it real? Is it JP Morgan where it looks like it's honest numbers, or are they doing modifications? Now, this is where it gets very, very, very complicated. Look at the massive growth in modifications coinciding with the time where they drop on the delinquencies. 24 Q2, 24 right there, right? It's so you see them build and then they drop. And this bugs me because I don't think you can trust these numbers. And the reason I say this is a Fed and OCC regulated entity, there's still some confusion on how those banks are being instructed or just kind of doing on their own their modifications. An FDIC bank is cumulative. It has to be cumulative. As you add more loan modifications, the number only ever gets bigger. So you can see this. There was a lot of confusion with the new rules that came in 23Q1. And a lot of banks wanted the FASB rules that were changed, which is you put them on, but after 12 months, they fall off. So you're only reporting flow. And you can see this. Modifications go up, go up, go up, and then they drop. Why do they drop? How do they drop? They either charge off, they get sold, or they mature. Or, which is now introduced in here, is it a reporting artifact? And so it almost looks like they fixed that reporting in Q4 of 2024, Q4, 2024 Q1, 2024 Q2. So realistically, that 85 number is fake. It should have been about 150, 160. In that scenario, it looks like they were reporting cumulative with the exception of 2023 Q4, which there was a lot of confusion. Everybody now is supposed to be reporting cumulative. I am very skeptical of OCC banks or Fed banks that basically show this drop off in modifications. I don't know if it's true or not true. If it is true, then they have to be because they're charging off or because they're being sold. Are they taking a lot of charge-offs? No, not at all. Are they taking a lot of REO? There's your construction. None, not at all. So how does the modifications go down? I don't know. I am skeptical that this bank is reporting cumulative modifications. I suspect they've got another $130, $140 million of construction modifications that aren't being reported. It's supposition. I don't really know, but I'm skeptical. We'll look at one more bank. We're going to pop down and we're going to basically look at Truist because both these banks have 5 basis points, which is almost too good to be true. Nobody should be at 5 basis points. You rarely see anybody down below 30, 40 basis points. There's another key bank at 9 basis points, another. So there can be banks, but I'm skeptical that you can have 8, 9, $10 billion of loans and no delinquencies. So let's go in and take a look. This looks very similar to US Bank, correct? Pop over here, put US Bank's total delinquencies, USB. You see the delinquencies climb, 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 climb. You see the delinquencies climb, climb, climb. Now they're not bad. 40, 58 basis points is not horrendous, but they just drop. How? Are they charging them off? Doesn't look like it. So how are delinquencies just dropping? Well, let's go look at the loan mods. And sure enough, what you see is exactly what you saw with Wells, exactly what you saw with Bank of America. Their total delinquencies drop. At the exact same time, they just start lowering payments to everybody. Delinquencies are $5 million and 5 basis points, $5 million and 5 basis points, but there's $133 million of extend and pretend. And so their total stress is upwards of 150, 160, 170 basis points. Well, Bill, it looks like it's going down. No, it's just the denominator growing. So this bank is doing a lot more lending, but they're reporting true numbers. Are they FDIC insured? So this is an FDIC, regulated bank. So you look at those modifications, those certainly look like they're cumulative. But you come over here to US Bank and you look at their modifications, and I'm skeptical. So it's no longer enough to look at delinquencies. It's no longer enough to look at loan mods. You also have to look, at least for now, and you have to ask the hard question, is it a regulatory reporting issue? And they've modified the rules, loan and pun intended, on loan mods. Yet again, they're supposed to be cumulative. But what I'm hearing out of banks and what I'm hearing out of regulators is that there is still some confusion, which is backed up in these numbers, whether every bank is reporting loan mods the exact same way. As always, I appreciate your time. If you have any questions, please reach out. Thank you.